Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for our Metals and Mining Conference. Our first live presentation is from Yellowcake. Yellowcake provides investors with direct exposure to the uranium market through physical holding of the uranium oxide concentrate. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book Meeting in the top toolbar. At this point, I'm very pleased to welcome Andre Liebenberg. He's the Chief Executive Officer of Yellowcake, which trades on the OTCQX Best Market under the symbol YLLXF and on the LSE AIM under the symbol YCA. Welcome back, Andre.
John, thanks very much, and thanks for the opportunity to present at this very interesting time in the uranium and nuclear markets. If we look at where we are now, there are a number of factors driving the nuclear space and the uranium commodity price. On the demand side, we've had a big move towards energy transition and carbon neutrality. We've seen a growth in the global nuclear reactor fleet, not only a growth, but also a sort of where we expected a decline in the fleet, particularly in the West. We're seeing reactors being kept alive and even restarted. Post the Russian invasion of Ukraine, we saw a big move towards energy independence and energy security. And against those demand backdrops, we're seeing a supply side with historic underinvestment. If you look at post-Fukushima, there's very little money that's gone into exploration and development of new projects. And if you look at what's happened to the uranium price over the last 5 years, we've seen a substantial increase because this increase in demand against a supply-constrained supply side. Just talking about Yellowcake for a moment, as John mentioned, we're a buyer and holder of physical uranium. We don't undertake any exploration or mining operations, so we don't cover any of those risks. We have a contract with Kazatomprom, which is the world's largest and lowest cost producer of uranium, where we can buy up to $100 million of uranium per annum, essentially at the spot price at our option, and that contract runs through to 2027. We store our uranium in safe jurisdictions. Most of our uranium is stored in Canada and some of it in France. And then we have a low-cost structure. We only have 2 full-time employees, myself and the CFO. We both work from home. We've outsourced our bookkeeping, accounting, uranium transactional activities. So it's a very skinny structure, and we target a cost base of less than 1% of net asset value. And last year, our total costs were about $13 million, of which storage is probably the biggest cost we have. Just turning to our balance sheet, we own today 21.7 million pounds of uranium, and if you take the spot price of around 69, that gives you $1.5 billion of asset value. We've got a little bit of cash. So, we don't have any debt structures. We don't have any hedges. It's a purely equity-financed balance sheet. During the time that we've been in existence, Yellowcake has become one of the largest companies on AIM and one of the most traded companies on AIM. We IPO'd in 2018. We bought our first 8 million pounds of uranium from Kazatomprom at $21 a pound. And since then, we have accumulated additional material to take us up to just shy of 22 million pounds today. We've raised over $800 million over the last 6 years. That's allowed us to accumulate this strategic inventory that we have. And during the period, our share price has done pretty well. The uranium spot price is up 260% since our IPO. Now turning to the uranium market and the nuclear sector, and I'll cover off those 3 demand side themes that I spoke about at the beginning, and then turn to the supply side. We've seen a big push in government policy that supports nuclear over the last 6-7 years. Around 150 countries have adopted net zero targets. And if you go back to COP28, we have over 31 countries now supporting a tripling of nuclear capacity by 2050. In the US in particular, we've seen the ADVANCE Act, which not only supports existing reactors, but also makes money available for new technologies and for advanced fuels. This ADVANCE Act will certainly be supportive of small modular reactors, which we think will play a key role in the energy sector going forward, in particularly as regards data centers and AI, and I'll speak a little bit about that later. If you look at electricity demand growth, which is the key driver of nuclear power, it's driven by two themes. In the developing economies, we're seeing a growth in the middle class and therefore a substantially increasing need for electricity. Whereas in the developed economies, we're seeing AI and streaming and the need for data centers making a big push on the demand for electricity. You're talking about electricity having to double by 2050 to meet some of these requirements. Looking at the existing nuclear fleet and where the growth is happening, we're seeing substantial growth in the Middle East and China and India. If you go back to the time of Fukushima 10 years or so ago, China had 17 operating reactors. Today, they have 58 operating reactors and are currently constructing another 29. It's significant growth in that area in support of lower carbon emissions, but also on the demand for steady power to support tech and data centers. India has a big development program. In the Middle East, we've seen the UAE recently complete a 4-reactor program, and they are now looking at a second program. We see that Egypt will have its first nuclear reactor operating in the next couple of years. Turkey are busy constructing reactors. So, a significant growth as regards new reactor build. And again, just focusing on China, just to put it in context, the US has the largest nuclear fleet today, probably around 90 odd reactors, then France. China, is just behind France in terms of existing reactors, but if you add those reactors that are currently under construction, and that excludes the reactors being planned, China will overtake France and by early into the next decade should overtake the US in terms of fleet size. Let me talk a little bit about hyperscale data centers and how that became a big theme in the nuclear sector last year. Just simply, if you look at a ChatGPT search versus a Google search, it uses about 10 times the energy requirements. So, increasingly demanding of power, and nuclear power is the perfect power source for data centers. These data centers host many, many GPUs, which are very, very sensitive to the quality of the power coming into those data centers. Wind and solar are not suitable for that sort of power requirement. Even coal, due to the fuel variability, can be problematic. So, gas and nuclear are perfectly suited. If you look at the growth forecast for data centers, just in the next couple of years, the power that will be required by these data centers will equate to what Japan as a country uses in terms of power today. About half the world's data centers are in the US, and 2023 saw almost $300 billion spent on data centers. I think the other thing that's become interesting is that the customers here or the balance sheets in that space are substantial. And last year we saw 14 of the biggest banks supportive of a tripling of nuclear. And it's kind of unsurprising when you think that no longer are you having to finance a utility balance sheet. Suddenly you're looking to finance the balance sheets of Amazon, Meta, and Microsoft, so a completely different game. But also on the data center side and the consumers there, they become, or they are in a sense, price insensitive as to power. You know, the power part of what is needed to run a data center and the competitive advantage that these new search engines have, it doesn't matter if you have to spend a few $1 billion on the nuclear power side if you're spending $100 billion on a data center. We saw in the last few weeks, President Trump announced the Stargate project, which is putting $500 million in support of AI infrastructure. This week, we saw President Macron in France follow suit, and he's talking about 100 million euros, so on a pro rata scale side, also in support of data centers and AI. And they're talking about setting aside 1 gigawatt of power just for data centers. So if you look at what that means for nuclear capacity growth in terms of all of these demand factors, and then the flow through to uranium, it is significant. Today, the demand for uranium from the nuclear power sector is about 190 million pounds of U3O8, uranium oxide. If you look through to 2035, that demand scenario grows to about 300 million pounds. So that's a 50% increase in a 10-year space. And if you think about how hard it is to discover new resources, to do the study work, to do all the permitting, to construct a mine, commission it, and ramp it up, 10 years is a very, very short time frame. So we think there's going to be a lot of pressure on the supply side going forward. The other feature of the nuclear industry is that utilities acquire about 85% of their fuel needs under long-term contracts. These are typically contracts that are negotiated 2 years prior to first fuel needs. And then the contract runs for about 5 years, and sometimes there are extension options. Because of the uncertainty caused by the Russian invasion and Russian fuel into the US, we've seen that US utilities have kind of stepped back, and their coverage needs are growing in the sense that they have a big uncovered requirement. These needs have to be secured. A nuclear fuel plant cannot run out of fuel. It costs hundreds of millions of dollars to restart. The Europeans are reasonably well covered in the mid-period. So this year, we are expecting US utilities to come back into the market. Certainly, we've seen the first few weeks of this year, we've seen about 17 million pounds of uranium put under long-term contract. On a pro forma run rate, that would be significantly above where we were last year. It's early days this year, but we do believe that we will see an increase in the contracting side. Just in terms of who uses uranium and who produces it, if you look at the biggest consumers of uranium, the United States essentially imports 100% of its uranium requirements. The US used to produce a lot of uranium. Those mines have kind of gone out of business. There are a number of mines that are looking to restart, but today the US imports pretty much all of its nuclear requirements or fuel requirements. China only has access to about 13% of its uranium requirements domestically. France imports all of its requirements. South Korea imports all of its requirements. So you've got a situation where the countries that consume uranium don't produce it. If you look at really what happened post the Russian invasion of Ukraine, that was a big blow to the fuel cycle, particularly in the West. Russia produces about 10-11% of the world's uranium, but it has 35% of the world's conversion capacity and 45% of the world's enrichment capacity. Historically, about 20% of the enriched fuel into the US came from Russia, and in Europe, it's about 30%. So, when that invasion happened, we saw last year that the President Biden signed into legislation a ban on Russian uranium or Russian nuclear fuel, that it comes into full effect in 2028. Between now and 2027, there is permissions may be granted to import fuel on a waiver basis. We saw President Putin react last year, back end of last year, and threaten to counter sanction fuel into the US. Late last year, 2 shipments that left Russia didn't contain any fuel. The 3rd ship left Russia that did contain fuel. So it's an uncertain scenario now for utilities in the US. And if you look at what's happened on the pricing side in the nuclear fuel cycle, the enrichment pricing or SWU pricing at pre the Russian invasion was about $40, and that today is about $190. So a dramatic increase in terms of enrichment pricing. On the conversion side, it's been even more dramatic. The price has gone from about $20 a kilogram up to $95, $96 a kilogram today. The West will build its own capacity. Conversion and enrichment are industrial processes. The technology exists, but it's going to take time. But on the supply side, the supply side is very concentrated. About 4 countries produce 75% of the world's uranium. Kazakhstan, Canada, Namibia, and Australia are the 4 countries that produce the bulk of the world's uranium. So the world is, or the nuclear utilities are very dependent on Kazakhstan as a country. It produces about 42% of the world's uranium. But we've seen China increasingly do contracts with Kazakhstan to the point where today about 50% of Kazakhstan uranium goes to China. And if you include Russia, in combination, Russia and China consume about 2/3 of Kazakhstan material. So, the world's biggest producer has very little left that can go to the West. So putting the supply side and the demand side together, we're seeing a widening gap between demand and supply. And I guess, more worryingly or more concerning is the fact that there's a heavy reliance on new projects to meet that gap. Now, we know in the mining industry, projects are generally over budget and generally do not come in on schedule. So if you look at the gray bars on the chart, if any of those bars push right in terms of timing or CapEx blowouts, a substantial gap is going to arise. So, if you look at the supply-demand situation, I firmly believe that in the next 3 years, we could easily see a supply crunch. We've got a very fragile supply side that's been underinvested in over the last 10 years in the face of a very exciting demand growth. Now, if I just sort of put that all together, we believe Yellowcake is very well positioned to benefit from these current trends. It's exciting on the demand side. We're seeing new demand growth in terms of big reactor build. I haven't really spoken about small modular reactors. There's a lot of excitement around that. There's something like 100 designs being worked on, by countries and by big companies. We see Sam Altman in the US and Bill Gates have got their own small modular reactor companies and businesses. The Chinese are currently building their own first small modular reactor. That'll be ready next year. And, once the Chinese build one, they'll build many. You've got companies like GE, Hitachi, and Rolls-Royce all operating in this space. We're also seeing a sort of a bifurcation in the uranium sector where, the material from Kazakhstan will go to Russia and China. Russian enriched fuel will now increasingly flow to China, India, Pakistan, Middle East, and some parts of South America, which leaves the Western utilities very exposed. And then again, as I mentioned, we've got a supply side that's fragile. So, in the context of growing demand, a fragile supply side, Yellowcake has 21.6 million pounds of uranium inventory. We think that the supply-demand picture means that the uranium price has to increase, and we believe we'll benefit from those tailwinds. So thank you. That concludes the presentation. I have a number of questions which I'll address. The first question I have is how quickly SMRs can come online in the US. I think that certainly by the end of the decade, we're going to see commercial reactors in operation. I think the reactors that are based on the traditional technology, so scaled down versions of current technology, will be the first that come to market. And the ones that are dependent on the higher enriched fuel and sort of advanced technologies may be a little slower. The other question I have is Kazatomprom our only supplier? Kazatomprom is the only company we have a firm supply agreement with, but we're not obligated to only buy from them. In the past, we have bought material in the spot market, so we are able to do that. But the beauty about the contract with Kazatomprom is that we can fix a price ahead of financing the purchase. I have a question here about the drivers of valuation and growth for Yellowcake. The biggest driver for the Yellowcake price and value is the uranium price. When we purchased our first batch of uranium at $21 back in 2018, we saw the uranium price peak out last January, February at $107. It sort of drifted back a bit, but I believe that there's still a lot of upward momentum in the uranium price. The incentive price for new projects is probably between $90 and $100. So we're below incentive pricing for new capacity. So the key driver for us is the uranium price. Obviously, if we can add some uranium, that would be nice. But $100 million contract now against a $1.5 billion market value is less significant than it was in the past. In terms of shareholder returns, dividends, and buybacks, because we don't generate much income, we don't pay dividends. We utilize our cash to pay our running costs. In the past, we have done share buybacks. It was helpful when we were a smaller company, but today we sit on about $20 million of cash, and we trade about $6-7 million of shares a day. So if we utilize even all of our cash to buy back our shares, we'd probably burn through it in a week, and I'm not sure it would make much difference. We've seen in the past that share buybacks tend to have a very temporary impact, and the market sort of goes back to where it was in the medium to longer term. I have a question here about what impact the additional physical uranium funds and ETFs had on the space, and do you expect those to grow further? That's a very good question. Today there are essentially only two companies that are physical holders of uranium. There's ourselves and the Sprott Physical Uranium Trust. Now, Sprott acquired a company called Uranium Participation Corporation back in 21. If you go back sort of 2 years, there was talk of a number of other funds. But I think because the liquidity in the spot market is very low, volumes have declined, the moment has almost passed for a second vehicle or another vehicle to come to market. So I think it's going to be very difficult for another vehicle to acquire sufficient volume to become relevant in the space. If you had to acquire even $100 million of uranium in the spot market today, it would certainly move the price a lot. So I don't see any further vehicles other than the Sprott vehicle and ourselves entering this market in the near future. There are other ETFs, and these ETFs would hold developers, producers, ourselves, big companies like Cameco and Kazatomprom. So they're really a blend of exposure across the whole nuclear or uranium space. We offer one-to-one leverage to the uranium price. We don't have any operational risk, and we don't have any gearing. So it's a different risk-reward proposition to, say, a developer or a project company or even a producer. Do you think the spot price is being artificially held down to stop new mines opening? I must say I'm struggling to understand why the spot price is where it is today, but that isn't really a driver of new mines. What new mines need is long-term contracts from producers at prices that allow them to develop those mines. And I think, if you look at where the term price, the long-term price today is sort of $80, $81. And even against that price, we are seeing some producers, some project companies stepping back. I think you need contracts at prices of $90 to $100 at least to get those mines into production. So, the spot market doesn't really influence new production. That will be influenced by, utilities writing contracts at sufficiently high prices to allow developers to get the project finance with firm offtakes to build out their mines. The question here about the cost curve and where the 90 percentile curve is, trying to get real cost data in this market is quite difficult. But I think the driver in sort of the medium term is not as much the cost curve, is just a lack of supply. So if you look at where we think primary production will end up for this year, maybe it's 160 million pounds at best this year, against, as I mentioned earlier, reactor demand of 190 million pounds. So you've got a primary deficit today, and that deficit is going to grow quite significantly. So really, the key here is not so much the cost curve in the short to medium term, but the need for new production. In the long term, supply will come. It always comes, and generally, after supply comes, you maybe have a period of sufficient or oversupply. And I think at that point, the cost curve matters and matters a lot. But certainly for the uranium sector in the immediate term, it's just about a lack of primary supply. I think I've pretty much covered all of the questions. So, really to John and the OTC, thank you very much for this opportunity. It's a very exciting time for the nuclear space and also for the uranium oxide as a fuel into that space. Appreciated the opportunity to talk to you all today. Thank you and goodbye.